It's a simple promise, whispered in the quiet hours of the night when you look at your portfolio statement. A promise of growth, of security, of a future where your capital works harder than you do. But for most, that promise is quietly being broken by a mathematical truth as certain as gravity, a law that governs the world of finance yet remains invisible to the 99% of investors who chase yesterday's headlines. They fill their portfolios with the titans of our age, the household names that dominate the news, believing that what was once true will be true forever. They look at a company that has already conquered the world and expect it to conquer it again and again and again. This is the great costly mistake of our time. It is the belief that an elephant can learn to gallop like a racehorse. The principle we are going to dissect today is not a secret stock tip. It is far more powerful. It is a fundamental law of the universe of business. It is much, much harder for a massive company to double in size than it is for a small, nimble company. This is the law of large numbers, and it is the silent killer of future returns for millions of investors. By expecting the giant, well-known stocks of today to produce the same spectacular, life-changing returns they delivered in the past, you are setting yourself up for a lifetime of mediocrity. You are anchoring your dreams of financial freedom to a ship that has already reached its destination and is now just trying not to sink. But what if you could change your perspective? What if you could learn to see the market not as a collection of famous names, but as an ecosystem of opportunities? This journey will transform you. You will learn to manage your expectations for the mega-cap stocks that everyone owns. More importantly, you will understand with deep and unshakable clarity why hunting for smaller, high-quality businesses, the hidden gems, the future giants, offers a genuine path to the kind of returns that don't just build wealth, but redefine a life. You will stop chasing the past and start investing in the future. You will learn to find the next generation of 10x stocks because you will finally understand where and how to look. The first pillar of this understanding is not a strategy or a tactic. It is a mathematical certainty, an anchor of logic in a sea of market emotion. We must first internalize the inescapable reality of the law of large numbers. This isn't just a quaint theory, it's a brutal gatekeeper of growth. To truly grasp its power, we must look at the man who has articulated it most clearly, not in his youth when he was nimble and fast, but in his later years, as the commander of the largest financial battleship the world has ever seen. We must look at Warren Buffett and the colossal challenge of managing Berkshire Hathaway. Imagine it's the early 2000s. The dot-com bubble has burst, and Warren Buffett, once derided as a fossil for avoiding technology stocks, looks like a prophet. The world is clamoring to give him their money. Berkshire Hathaway, his investment vehicle, is no longer the scrappy partnership he started in the 1950s. It is a behemoth. By 2005, its market capitalization is over $130 billion. Its book value is growing at a pace that is staggering. But inside the quiet offices in Omaha, Buffett is facing a problem that most investors would dream of, but which he describes as a genuine anchor on his performance: the sheer suffocating weight of his own capital. In his annual letters to shareholders, he begins to speak of this problem with increasing frankness. He uses a powerful analogy. In his early days, managing a few $1 million was like captaining a nimble speedboat. He could zip in and out of tiny harbors, exploring overlooked opportunities in small-cap stocks, obscure bonds, and arbitrage situations that no one else cared about. If he found a tiny, undervalued company trading for half its liquidation value, he could put a significant portion of his partnership's capital into it and generate a 50 or 100% return. A $1 million profit on a $5 million fund is a 20% annual return from a single idea. It was a game of agility, of finding mispriced assets so small that the big Wall Street firms couldn't even be bothered to look at them. But now, he was no longer in a speedboat. He was at the helm of an aircraft carrier. By the mid-2000s, Berkshire Hathaway had tens of billions of dollars in cash piling up. To make that money do anything meaningful, to move the needle on Berkshire's overall performance, He couldn't invest in a $5 million company anymore. An investment had to be in the billions of dollars to even matter. If he bought a $10 million company and it doubled, the $20 million position would be a rounding error on Berkshire's balance sheet. It was like an elephant trying to survive by eating ants one by one. The effort required would expend more energy than the nourishment gained. Buffett laid out the math for his shareholders with brutal honesty. To achieve his historical growth rates of over 20% per year, Berkshire's value would need to increase by tens of billions of dollars every single year. Let's put that in perspective. In 2007, Berkshire's net worth was about $123 billion. To grow at 20%, he needed to find a way to generate nearly $25 billion of value in a single year. That is the entire market capitalization of a company like, at the time, Hershey's or General Mills. He couldn't just find a good idea. He had to find an idea the size of an entire Fortune 500 company, buy it at a reasonable price, and have it grow. And he had to do this every single year. The universe of potential investments shrinks dramatically when you can only look at mega-cap stocks or whole companies for acquisition. The small ponds where he did his best fishing were now off limits. He had to hunt for whales, and whales are smart, scarce, and rarely sell for cheap. This is the law of large numbers in its most practical form. The bigger you get, the harder it is to find opportunities that are large enough to make a difference, pulling your growth rate inexorably down towards the average. The deep-seated reason we fail to grasp this is a fundamental flaw in our own mental software. It's a cognitive bias known as the linearity bias. Our brains are wired for simplicity. We evolved to solve immediate, straightforward problems. If you walk in a straight line, you will get to the water. If you plant one seed, you get one plant. We naturally tend to extrapolate past events into the future in a straight line. We see a stock like Amazon or Apple that has delivered mind-bending returns for 2 decades, and our brain instinctively draws a straight line on the chart, projecting that same trajectory into the future. We see that it grew 1,000% over the last decade, and we subconsciously assume it can do it again. But growth in business and finance is not linear. It is geometric and subject to constraints. The linearity bias blinds us to the sheer mathematical absurdity of our own expectations. A $1 billion company needs to find $1 billion of new value to double. A $2 trillion company needs to find $2 trillion of new value to double. That's a number so vast it's difficult to comprehend. It's more than the entire gross domestic product of countries like Canada or Brazil. It means that for a company like Apple to double from its current size, it must create a new business empire equivalent in value to adding the entire economies of Italy or Russia to its balance sheet. Where does that growth come from? How many more phones can they sell on a planet with a finite number of people? How many more services can they add before they are competing with every other company on Earth? The law of large numbers is not just a suggestion, it is the brutal reality of market saturation, competition, and the simple limits of scale. Our brain's desire for simple, linear projections is a catastrophic bug when applied to the complex, logarithmic world of corporate growth. It is this bias that leads millions to pile into the giants, expecting a repeat performance that is mathematically and logically all but impossible. So how do we override this flawed mental software? We need a practical, applied mental model, a blueprint for thinking that forces us to confront the numbers head-on. Let's call it the growth requirement calculation. It's a simple, back-of-the-envelope exercise you can do for any megacap stock you own or are considering buying. It translates vague hopes about future growth into cold, hard numbers. Step 1. Take the company's current market capitalization. Let's use a hypothetical tech giant, Megacorp, with a market cap of $2 trillion. Step 2. Define your desired return. Let's say you want the stock to be a 10x winner over the next decade. That means you want it to be worth $20 trillion in 10 years. A more modest goal might be a simple double or a 2x return, meaning you want it to be worth $4 trillion. Step 3. Calculate the required new value. To go from $2 trillion to $4 trillion, Megacorp needs to create $2 trillion in new shareholder value. This is your target. Step 4. Translate value into fundamentals. Here is the crucial step. A company's market cap is ultimately a reflection of its future earnings and cash flows. A common rule of thumb is that a mature company might trade at, say, 20 times its annual earnings. To justify $2 trillion in new market value, Megacorp would need to generate an additional $100 billion in pure annual profit. Not revenue, profit. Step 5. The sanity check. Now, you must ask the most important question. Where on earth is that $100 billion in new annual profit going to come from? Is there a new market Megacorp can enter that is large enough? Can they invent a new product category that will generate that kind of income? Remember, this is asterisk on top of the massive profits they already make just to maintain their current valuation. When you force yourself to do this calculation, the linearity bias shatters. You move from a fuzzy, hopeful belief in a company's greatness to a concrete, quantifiable challenge. You realize that for your mega-cap stock to double, it needs to achieve a business feat of unprecedented scale, conquering new worlds of commerce. Now contrast this with a small-cap stock. A $500 million company only needs to find another $500 million in value to double. To do that, at the same 20x earnings multiple, it needs to generate $25 million in new annual profit. That is still a challenge, but it is a human-scale challenge. It can be achieved by winning a few large contracts, expanding into a new region, or launching one successful new product. One is a quest for the Holy Grail, the other is just good business. This mental model doesn't give you the answer, but it forces you to ask the right and brutally difficult questions. To truly understand the danger of ignoring this law, we must examine the path of the 99%, the road littered with the portfolios of those who believed size was synonymous with safety and past success was a guarantee of future riches. There is no better example of this folly than the story of Cisco Systems during the dot-com bubble. In the late 1990s, Cisco was not just a great company, it was the physical embodiment of the Internet revolution. It manufactured the routers and switches that were the plumbing of the new digital world. As Internet traffic exploded, Cisco's revenues and profits soared. Its stock followed, becoming a rocket ship of wealth creation. Investors, gripped by the linearity bias, saw its trajectory and believed it was unstoppable. It was the ultimate growth stock. By March of 2000, the mania reached its zenith. Cisco Systems briefly became the most valuable company on the planet, with a market capitalization exceeding $500 billion. Pundits and analysts tripped over themselves to justify why it was still a buy. They created new valuation metrics, talked about eyeballs and network effects, and projected its growth in a straight line to the sky. Retail investors poured their life savings into the stock, believing they were buying a piece of the future, a one-way ticket to financial freedom. They were buying at a price-to-earnings ratio of over 100. They were not buying a business, they were buying a dream, a story, a ticket to a party they believed would never end. And then the music stopped. The dot-com bubble burst. The absurd growth projections evaporated. Companies that had been ordering millions of dollars of Cisco equipment went bankrupt. The demand cratered. Cisco's business was still fundamentally good, but it was not good enough to justify the insane valuation the market had placed on it. The stock began a brutal, gut-wrenching collapse. Within 2 years, it had lost over 80% of its value. But here is the most terrifying part of the story, the part that truly illustrates the law of large numbers. An investor who bought Cisco at its peak in March of 2000, even after the subsequent decades of technological progress, even after Cisco remained a dominant and profitable company, would still be underwater on their investment today, more than 20 years later. They have been waiting for 2 decades, just to get back to even. All the innovation, all the profits, all the buybacks, none of it was enough to overcome the impossible starting point. The company was simply too big, and the valuation was too high for any realistic future growth to ever bail them out. That is the ultimate price of ignoring the law of large numbers. You can be right about the quality of a company and still lose money for decades because you were wrong about the math of its future growth. The direct financial connection of this principle is what separates successful wealth management from wishful thinking. It appears most starkly when we compare two hypothetical portfolios. Let's imagine Portfolio A, belonging to a typical investor. They invest $100,000 into a basket of today's giants: Apple, Microsoft, Amazon, Google. These are wonderful businesses, the Ciscos of our time. But their combined market capitalization is in the trillions. For this portfolio to 10x, to turn that $100,000 into $1 million, these companies would need to reach market caps of 10, 20, or even $30 trillion each. They would need to become larger than the entire U.S. economy. The sheer physics of capital makes this a near impossibility. The growth required is astronomical. Now consider Portfolio B. This investor also starts with $100,000, but instead of buying the giants, they follow a different path of asset allocation. They create a diversified portfolio of 10 promising small-cap stocks, each with a market cap of around $1 billion. They invest $10,000 in each. For Portfolio B to 10x, it does not need all 10 companies to become $10 billion behemoths. The mathematics of portfolio growth is far more forgiving and far more explosive. Perhaps 5 of the companies go nowhere or even fail. 2 of them do reasonably well and double or triple. But 1 or 2 of them, the ones that truly execute, that capture their market, that become the hidden champions, might go up 20x, 30x, or even 50x. A single $10,000 investment that becomes a 30x winner turns into $300,000. That one success story alone can more than triple the entire initial portfolio. The final capital gains are not driven by the average performance of the group, but by the asymmetric outsized return of 1 or 2 big winners. This is the financial engine that venture capital runs on. They know most of their bets will fail, but the one success pays for everything and then some. By fishing in the small-cap pond, you give yourself a chance at that asymmetry. You are trading the near certainty of modest, market-like returns from the giants for the statistical probability of life-changing returns from finding the giants of tomorrow. That is the tangible, financial advantage of respecting the law of large numbers. Once we accept the mathematical constraints of size, we must confront a deeper, more emotional question. Why are we so drawn to these giants in the first place? If the math for future returns is so clearly stacked against them, why do the vast majority of retail investors continue to fill their portfolios with the same handful of mega-cap stocks? The answer lies not in financial statements, but in the primal wiring of the human brain. We are caught in what can only be described as the glamour trap of the giants, a psychological vortex of safety, consensus, and familiarity that feels comfortable but is devastating to long-term portfolio growth. To understand this phenomenon, we must travel back to a different era of market euphoria, a time before big tech, to the late 1960s and early 1970s. This was the age of the Nifty 50. This was a group of about 50 large-cap growth stocks on the New York Stock Exchange that were seen as the bluest of blue chips. Companies like Coca-Cola, IBM, Polaroid, McDonald's, and Xerox. They were the titans of their day, dominant, profitable, and seemingly invincible. Wall Street analysts and the burgeoning class of institutional money managers sold a powerful and seductive story about these stocks. They were one-decision investments. The idea was that you could buy them at any price, lock them away, and hold them forever. Their quality was so supreme, their growth so certain, that valuation was a secondary concern. You didn't need to worry about market timing or economic cycles. You just had to own the best. This narrative created a self-reinforcing feedback loop. As more and more institutional money poured into this limited number of stocks, their prices soared, seemingly validating the initial thesis. A retail investor in 1972 would have felt immense pressure to own these names. All their friends were talking about them. The newspapers lauded their success. Their broker recommended them with unwavering confidence. To not own the Nifty 50 was to feel foolish, to be left behind. The valuations reached absurd levels. Companies that were growing earnings at 10% a year were trading at price-to-earnings ratios of 50, 60, or even 90. The price had become completely detached from the underlying business fundamentals. But in the grip of the glamour trap, no one cared. Then came the brutal bear market of 1973-74. The economy soured, inflation spiked, and the market crashed. The Nifty 50, once seen as pillars of safety, were utterly decimated. Coca-Cola fell by over 60%. Polaroid, a darling of the era, collapsed by over 90%. Avon dropped 86%. The one-decision stocks became a source of catastrophic losses. It took many of these stocks more than a decade to reclaim their previous highs. The lesson was brutal and clear. There is no company so good that you can buy it at any price. Quality is not a substitute for valuation. The glamour, the story, the feeling of safety in the crowd, it was all an illusion. This historical episode is a perfect mirror for our current fascination with a handful of mega-cap technology stocks. The names have changed, but the psychology is identical. The core psychological principle driving this behavior is the powerful one-two punch of social proof and herd bias. As social creatures, we are deeply programmed to find safety in numbers. Our ancestors survived on the savannah by sticking with the tribe. If everyone in the tribe suddenly started running, you didn't stop to analyze the situation. You ran too. To do otherwise was to risk being eaten by a lion. This instinct is alive and well in financial markets. When everyone we know, from our neighbor to the experts on television, is buying and praising the same handful of stocks, our brain interprets this consensus as a signal of safety and correctness. Owning Apple or Microsoft feels less risky than owning some obscure $500 million industrial software company, not because we've done a deep financial analysis, but because our social brain is being soothed by the crowd. We are running with the herd. Compounding this is the familiarity principle, a well-documented cognitive bias where we develop a preference for things simply because we are familiar with them. We use these companies' products every day. We see their logos, read news about their CEOs, and watch their product launches. This constant exposure creates a false sense of understanding and comfort. We mistake familiarity with the product for expertise in the investment. We feel like we know to a stay the company, so investing in it seems like a natural, low-risk choice. This cocktail of social proof and familiarity creates the glamour trap. It leads us to equate famous with safe and popular with profitable, causing us to over-concentrate our capital in the most obvious, most talked about, and often most overvalued assets in the market, while completely ignoring the vast universe of less familiar but potentially far more lucrative investment opportunities. To escape this trap, you need an active strategy, a mental model that forces you to invert the conventional process of discovery. We can call this the scuttlebutt inversion method, a concept borrowed from the legendary investor Phil Fisher and heavily utilized by Buffett. The typical investor's process is top-down and media-driven. They see a headline about a popular company, hear a stock tip from a friend, and then maybe do some superficial research to confirm their pre-existing desire to buy. The scuttlebutt inversion flips this on its head. Step 1. Start with a niche, not a name. Instead of beginning with a list of popular stocks, begin by identifying a small but rapidly growing microtrend or an unsolved problem in a specific industry. Forget about AI in general. Think about AI-powered diagnostic tools for rural hospitals. Forget about e-commerce. Think about logistics software for last-mile delivery of perishable goods. The key is to get granular and find a pond that is too small for the big Wall Street sharks to care about. Step 2. Become a hunter, not a target. Use stock screening tools to actively search for companies that operate in the niche you've identified. You can set specific criteria. market capitalization under $2 billion, located in a certain region with consistent revenue growth. This turns you from a passive recipient of media narratives into an active hunter seeking specific prey. Step 3. Do the real work, the scuttlebutt. This is the heart of the process. Once you have a list of 2 or 3 potential companies, you must investigate them from the ground up. This means going beyond the financial statements. If it's a software company, try to get a demo of their product. Find their customers on LinkedIn and ask them what they think of the service. Read industry trade journals. Search for reviews on forums. If possible, talk to former employees. You are trying to answer a simple question. Is this a truly great business that the rest of the market just hasn't discovered yet? This inverted model is powerful because it forces you out of your comfort zone. It shatters the familiarity principle by compelling you to learn about obscure businesses. It neutralizes herd bias because you are, by definition, looking where the herd is not. You are generating your own ideas from first principles, building a conviction based on deep proprietary research, not on social consensus. This is the hard work of professional stock picking, and it's the only reliable way to find those hidden gems before they become glamour stocks. The path of the 99%, the antithesis of this diligent approach, can be seen in the modern Robinhood phenomenon. The rise of commission-free trading apps has empowered a new generation of retail investors, which is a fantastic development. However, it has also amplified the glamour trap to an unprecedented degree. Look at the most popular lists on these platforms. It's almost always the same 10 or 15 names, the mega-cap tech stocks and a few volatile meme stocks that are famous for being famous. The typical behavior is this: a new investor, armed with a few hundred or a few $1,000s, opens an account. They are presented with a fire hose of information, headlines, and social media chatter, all focused on the same handful of stocks. They see these stocks going up, they see a community of people online cheering them on, and they dive in. They are not investing based on a calculation of intrinsic value or a deep understanding of the business model. They are investing as a form of social participation. The result is a portfolio that is dangerously concentrated, emotionally driven, and almost perfectly designed to underperform. It is the illusion of active investing. They are picking stocks, after all, but without any of the analytical rigor that creates a genuine edge. They have simply created a personalized, high-fee, poorly timed version of an S&P 500 index fund. They are taking on the risk of individual stocks without the potential for outsized returns that comes from true, independent discovery. This is the modern face of the herd, and it inevitably leads to the same place the owners of the Nifty 50 ended up: disappointment. The direct financial consequence of falling into the glamour trap is a concept that every serious investor must understand: multiple compression. A stock's price is, loosely speaking, its earnings per share multiplied by its price-to-earnings (PE) ratio, or multiple. The multiple is a reflection of the market's enthusiasm and expectations for a company's future growth. When you buy a glamour stock, you are often paying a very high multiple, say 50 times earnings, because the story is exciting and everyone expects spectacular growth. Here's the danger. Let's say you buy that stock, and, over the next 5 years, the company performs well. It successfully grows its earnings by a very respectable 10% per year. However, during that time, the glamour fades. The growth, while good, is not as explosive as people had hoped. The market sobers up and decides that this company is now only worth a more reasonable multiple of 25 times earnings. What happens to your investment? Even though the business's earnings grew, your stock price may have gone nowhere, or even declined. The growth in the underlying earnings was completely offset by the collapse in the PE multiple. This is multiple compression, and it is the silent thief that robs investors in popular stocks of their returns. Now contrast this with the financial power of its opposite, multiple expansion. When you use the scuttlebutt inversion method to find a high-quality small-cap stock that nobody is paying attention to, you might be able to buy it at a low multiple, say 10 times earnings. Over the next 5 years, as the company executes its business plan and grows, the market starts to discover it. Wall Street analysts begin to cover it. It starts showing up on stocks-to-watch lists. The story gets out. Now, not only are its earnings growing by 15 or 20% a year, but the market is also willing to pay a higher multiple for those earnings, say 20 or 25 times. In this case, you get a powerful double whammy effect. Your return is the growth in earnings plus the growth in the multiple. This is how 10x stocks are made. It's not just about finding a growing business. It's about finding a growing business before its popularity is reflected in its price. Avoiding the multiple compression of the glamour stocks and capturing the multiple expansion of undiscovered gems is the direct, quantifiable financial advantage of leaving the herd behind and doing your own work. Having established the mathematical limits of giants and the psychological traps they set, we must now turn to the master himself and examine how he put this theory into practice. Before Warren Buffett was the commander of the Berkshire Hathaway aircraft carrier, he was the swashbuckling captain of a financial speedboat. It was in his early partnership days from 1956 to 1969 that he generated the most spectacular returns of his career, compounding his investors' money at nearly 30% per year. He did this by rigorously applying what we can call Buffett's small pond strategy. He understood that his small size was a massive competitive advantage, allowing him to fish in obscure, inefficient corners of the market where the big money couldn't go. His early success was built not on buying the famous Nifty 50, but on finding tiny, unloved, and deeply undervalued companies. One of the most illuminating examples of this strategy in action is his investment in the Dempster Mill Manufacturing Company in the mid-1950s. This was the furthest thing from a glamour stock. Dempster was a small, sleepy manufacturer of windmills and farm irrigation equipment based in Beatrice, Nebraska. It was a classic Ben Graham-style net stock, meaning the company's market capitalization was trading for less than its net current assets, essentially less than the value of its cash, receivables, and inventory after subtracting all liabilities. In theory, you could buy the whole company, liquidate its working capital, pay off its debts, and walk away with a risk-free profit. The factory and brand would be free. Buffett began buying shares in 1956. He patiently accumulated a large position, recognizing that the market was completely ignoring the real asset value sitting on Dempster's balance sheet. But this wasn't just a passive investment. As his stake grew, he realized the company was being poorly managed. The management team was squandering the company's assets on unprofitable operations. So Buffett took an activist role. He got a seat on the board of directors. He saw firsthand that the existing CEO was not making the tough decisions necessary to unlock the company's value. In a bold move for the young investor, he orchestrated a management change, bringing in a sharp operator named Harry Bottle to turn things around. Bottle was ruthless in his efficiency. He sold off excess inventory, cut unprofitable product lines, and streamlined operations. In short, he unlocked the value that Buffett had identified on the balance sheet. Within a couple of years, Buffett was able to sell his stake for a massive profit, generating a spectacular return for his partners. This story is a perfect microcosm of the small pond strategy. First, the opportunity itself, a tiny, boring farm equipment company, was completely off the radar of the big Wall Street firms. Second, Buffett's capital was small enough that he could build a controlling position without moving the stock price too much. Third, and most crucially, he was able to exert influence. He became the big fish in that very small pond. His intellect and capital had an outsized impact on the outcome. Could Warren Buffett do this today with a company like Johnson & Johnson or Procter & Gamble? Absolutely not. He is now a whale, and whales can't swim in backyard ponds. His early success was a direct result of exploiting the advantages of being small and nimble. The psychological principle underpinning this entire strategy is what Buffett famously calls the circle of competence. This is a deceptively simple, yet profoundly powerful idea. It states that you don't have to be an expert on every company or even many companies to be a successful investor. You only have to be able to correctly evaluate companies within your own self-defined area of expertise. Your goal is not to have the biggest circle but to know the perimeter of your circle with absolute precision and to never, ever step outside of it. In his early days, Buffett's circle was comprised of these small, simple-to-understand businesses. He could look at the balance sheet of a company like Dempster Mill and know, with near certainty, the value of its assets. He understood the economics of manufacturing, retail, and insurance. He didn't venture into complex technology or pharmaceutical companies whose futures were difficult to predict. This disciplined approach provided a powerful psychological advantage. By staying within his circle, he could act with incredible conviction when he found an opportunity. His deep knowledge of a few specific areas overrode the fear and uncertainty that paralyzes most investors. It allowed him to make large, concentrated bets because he wasn't guessing. He was operating from a position of profound informational and intellectual superiority. This is the opposite of the retail investor who owns 25 different stocks across 10 industries, knowing just a little bit about each. That investor has no circle of competence, only a circle of familiarity, and thus can never invest with real conviction. We can translate this into an actionable blueprint for today's investors and entrepreneurs, a mental model we can call the Big Fish Small Pond framework. It's a systematic way to create your own unfair advantage in the market. Step 1. Define your pond. This is the most important step. You must honestly assess your own unique knowledge base. What industry, technology, or market segment do you understand better than 99% of other investors? Maybe it's not an industry, but a business model. Perhaps your career in sales has given you a deep understanding of customer relationship management software. Maybe your hobby as a cyclist gives you unique insight into high-end component manufacturers. Your pond could be dentistry software, B2B payment processing in Southeast Asia, or companies that benefit from new water-saving regulations. It must be specific, and it must be an area where you have a genuine edge. Step 2. Survey the inhabitants. Once you've defined your pond, your job is to identify every publicly traded company that lives within it, especially the small ones. Use financial data services and stock screeners to find all the players with market caps under, for example, $5 billion that operate in your chosen niche. Step 3. Separate the minnows from the piranhas. Now, you analyze these companies for quality. You are not just looking for cheap stocks, you are looking for excellent small businesses. This means diving into their financials. Do they have strong balance sheets with little debt? Do they generate consistent free cash flow? Is management a significant owner of the stock? You are looking for the dominant fish within your small pond. Step 4. Become the world's leading expert. Pick the 1 or 2 most promising companies from your list and go deeper than anyone else. Read every annual report, listen to every investor call, research the CEO's track record, and use the scuttlebutt method we discussed earlier. Your goal is to know more about this $1 billion company than any Wall Street analyst does. When you reach this point, you have successfully replicated Buffett's early advantage. You have become the big fish in a small pond, and you can now make investment decisions with the same kind of data-driven conviction he did. The antithesis to this focused, competency-driven approach is a trap that ensnares countless well-intentioned investors, the trap of diversification. This term, coined by another legendary investor, Peter Lynch, describes the process of adding more and more stocks to your portfolio in the name of diversification, to the point where you have simply created a watered-down, expensive, and inefficient version of an index fund. The average investor, fearful of the perceived risk of small companies, might decide to play it safe by buying 30 or 40 different large-cap stocks. They'll own a bank, a car company, a retailer, a software company, and a pharmaceutical giant. They believe they are prudently spreading their risk. But what have they actually accomplished? They have guaranteed that their performance will be, at best, mediocre. They cannot possibly be an expert, In all of these disparate industries, they have no analytical edge in any of their holdings. They are completely reliant on the general upward movement of the market for any returns. Worse, they have taken on the hassle and potential for error of individual stock picking, without any of the potential upside that comes from making a concentrated bet on a truly great undiscovered idea. It is the worst of both worlds. Buffett himself has said that wide diversification is only required when investors do not understand what they are doing. The path of the 99% is to diversify into a portfolio of mediocrity. The path of the master is to focus, to build a deep circle of competence in a small pond, and to wait patiently for a truly extraordinary opportunity to appear within it. The direct financial connection between Buffett's small pond strategy and superior returns lies in the powerful concept of return on invested capital, or ROIC. ROIC is a measure of how efficiently a company is using its capital to generate profits. A high ROIC is the hallmark of a truly great business. And the truth is, it is far easier to find companies with extraordinarily high and sustainable ROIC in the world of small, niche businesses. Consider a small, specialized software company. Its primary assets are its code and the brains of its engineers. It doesn't need massive factories or huge amounts of working capital. It can grow its revenue significantly without much additional investment. Such a company can achieve an ROIC of 30, 40, or even 50%. Now consider a massive industrial giant or a major bank. Its business is incredibly capital-intensive. It requires billions in plants, equipment, and regulatory capital just to operate. For these giants, an ROIC of 10 or 15% would be considered excellent. When you build a portfolio, you are essentially creating your own holding company. If you fill that portfolio with small companies that can consistently reinvest their earnings at 30 or 40%, your capital will compound at a rate that is mathematically impossible for a portfolio comprised of mega-cap stocks that can only reinvest at 10%. The difference may seem small in a single year, but over a decade or two, the gap in your final wealth becomes a chasm. This is the hidden financial engine behind the small pond strategy. You are deliberately seeking out the most efficient capital compounding machines in the market, which are most often found in the small cap universe, long before they become large, mature, and inevitably less efficient. That is how you build the kind of portfolio growth that leads to true, lasting financial freedom. We have now established the mathematical ceiling for giants, the psychological pull that draws us to them, and the historical strategy Buffett used to outperform by avoiding them. The next logical step is to operationalize this knowledge. We must evolve from a passive investor who buys what is popular into an active hunter, equipped with the right mindset and the right tools to find the next generation of wonderful companies. This requires a fundamental shift in your search criteria, moving away from the glamour of the crowd and toward the quiet quality of undiscovered businesses. The perfect anecdote to illustrate this mental evolution comes not just from Buffett, but from the profound influence of his partner, Charlie Munger. For years, Buffett was a strict disciple of his mentor, Benjamin Graham. Graham's approach, which we saw with the Dempster Mill Company, was all about cigar butt investing. The idea was to find a discarded cigar butt on the street that had one last, free puff left in it. In investment terms, this meant buying fair companies at wonderful prices. You would buy a mediocre business simply because it was trading at a statistical discount to its asset value, sell it when the price recovered, and repeat. It was profitable, but it wasn't scalable, and it didn't allow for the magic of long-term compounding. Then came Charlie Munger. Munger pushed Buffett to evolve his thinking. He argued that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The seminal moment in this transformation was their acquisition of See's Candies in 1972. On a purely Graham-like statistical basis, See's was not particularly cheap. Buffett was hesitant to pay the asking price of $25 million because it was significantly more than the company's book value. But Munger saw something deeper. See's was not just a candy company, it was a phenomenal business. It had a beloved brand, incredible customer loyalty, and most importantly, pricing power. It could raise its prices every year to account for inflation without losing customers. This created a gusher of cash flow that required very little additional capital investment. It was a compounding machine. Buffett later admitted that if he hadn't listened to Munger, he would have missed out on one of the best investments he ever made. See's Candies went on to generate billions of dollars in profit for Berkshire Hathaway over the decades, all from that initial $25 million purchase. This story marks the crucial pivot in the hunter's mindset, the shift from hunting for what is merely cheap to hunting for what is truly great. A cheap, mediocre small-cap company might give you a one-time 50% pop. A great, fairly priced small-cap company can compound your wealth for decades and become a true 10x or 100x winner. This is the mindset we must adopt. Adopting this mindset is difficult because it requires fighting against our own deeply ingrained psychological biases. When we own a large, famous stock that has done well for us, we fall prey to a toxic combination of confirmation bias and the endowment effect. Confirmation bias is our tendency to seek out and interpret information in a way that confirms our existing beliefs. If we own a giant tech stock, we'll eagerly click on headlines that praise its new product, while quickly dismissing articles that highlight its growing competition or antitrust risks. The endowment effect is our tendency to overvalue something simply because we own it. That stock in our portfolio feels more special and more valuable than it would if we were evaluating it as a neutral outsider. The hunter's mindset requires a ruthless campaign against these biases. It demands what is often called strong opinions, weakly held. You must be able to do deep research and build a strong thesis for why a small company is a great investment, but you must hold that thesis weakly enough that you are constantly and actively trying to disprove it. You must seek out the bear case. You must ask, what could go wrong? Why might I be mistaken? This active, skeptical mindset is the polar opposite of the passive, validating mindset of the investor who is emotionally attached to their glamour stocks. The hunter is a detective looking for flaws in the case, not a cheerleader hoping for the best. This psychological discipline is what separates the amateur from the professional, and is the essential foundation for successfully picking small-cap stocks. To turn this mindset into a repeatable process, we need a practical tool, a blueprint. Let's call it the small-cap quality checklist. This is a filter you can apply to any potential investment to see if it meets the criteria of a wonderful company before you even start your deep dive. It is not a substitute for judgment, but a crucial starting point. 1. Market cap under a clear ceiling. Let's set the bar at $2 billion. This ensures you are fishing in a pond that is generally too small to attract massive institutional attention, giving you a potential information edge. 2. Positive and growing free cash flow. Forget reported earnings, which can be manipulated with accounting tricks. Free cash flow is the real, hard cash the business generates after all expenses and investments. You want to see a track record of at least 3 years of positive and, ideally, growing free cash flow. This is the lifeblood of a healthy business. 3. High insider ownership. Look for companies where the CEO, founders, and management team own a significant chunk of the stock, ideally more than 10%. When their personal net worth is tied up in the company's success, their interests are perfectly aligned with yours as an outside shareholder. They will think like owners, not like hired hands. 4. A fortress balance sheet. In the world of small companies, financial strength is paramount. Look for a low debt-to-equity ratio. A company that is not burdened by heavy interest payments is more resilient during economic downturns and has the flexibility to invest in growth opportunities when they arise. 5. A demonstrable competitive moat. This is the most important qualitative factor. Can you articulate in a single, simple sentence why this company's customers can't or won't switch to a competitor? The moat could be a powerful brand, like See's Candies, a patent, high switching costs for its customers, or a network effect. If you can't easily define the moat, it probably doesn't exist. 6. A large and growing runway. The company must be operating in a market, a total addressable market, or TAM, that is large enough to support significant future growth. A great company in a tiny, stagnant market has limited potential. You want to find the future big fish in a pond that is rapidly expanding into a lake. This checklist acts as a powerful antidote to the most common mistake made by the 99% story stock investing. The antithesis of our diligent, checklist-driven hunter is the investor who falls in love with a grand narrative. They hear about a small biotech company that is going to cure cancer, or a new electric vehicle company that is the next Tesla. They get swept up in the excitement, the vision, the story. They imagine a utopian future where the company has succeeded beyond all dreams, and they buy the stock based on that feeling, without ever looking at the financial reality. The problem with story stocks is that they are all sizzle and no steak. Often, these companies are burning through cash, have mountains of debt, and have no clear path to profitability. Their stock prices are propped up entirely by hope and hype. When a dose of reality hits, a clinical trial fails, a production target is missed, the story shatters, and the stock price collapses, often overnight. The hunter with the checklist would have screened this company out at Step 2, no free cash flow, or Step 4, high debt. The story stock investor, seduced by the narrative, skips the checklist entirely and ends up holding a worthless bag. A compelling story is a great starting point for research, but it is a catastrophic substitute for it. The direct financial connection that makes the hunter's mindset so profitable is the concept of operating leverage. This is one of the most powerful forces in finance and is most potent in smaller, growing companies. Operating leverage refers to the relationship between a company's fixed costs and its variable costs. A company with high fixed costs, like factories, software development, or a sales force, and low variable costs, the cost to produce one more unit, has high operating leverage. Let's illustrate with a simple financial model. Imagine Megacorp, a giant industrial company. It has massive fixed costs, but also huge variable costs for raw materials and labor. If its revenue increases by 10%, many of its costs will increase as well, so its profits might only increase by 12%. Now consider SmallCorp, a young software-as-a-service company. It has already spent the money to build its software platform, a fixed cost. The cost to add one more customer is near zero, a low variable cost. When SmallCorp's revenue increases by 10%, virtually all of that new revenue drops straight to the bottom line. Its profits might soar by 50 or even 100%. This is the financial engine that powers explosive stock returns. As a small company grows, and its revenue starts to scale beyond its fixed cost base, its profitability can hit a dramatic inflection point. A diligent hunter who uses the quality checklist is specifically looking for businesses with this latent potential. They are buying the company just before this profit explosion occurs. The rest of the market, which only looks at past earnings, will miss it. By focusing your search on high-quality small businesses with scalable models, you are positioning yourself to capture the massive capital gains that are unleashed by the power of operating leverage. We have arrived at the final pillar. We understand the math, we've diagnosed the psychology, we've studied the master's strategy, and we've built the hunter's toolkit. Now, we must bring it all together into a coherent plan of action. It's not enough to find a potential 10x stock. You must know how to incorporate it into your financial life. This is the science of portfolio architecture for asymmetric returns, a structure designed to withstand failures while maximizing the impact of your rare, spectacular successes. A poignant story from Buffett's career that illustrates the conviction required for this approach is his investment in the Washington Post Company in 1973. This was post-Nifty 50 crash, and the market was a bloodbath of fear and pessimism. The Washington Post, despite being a premier newspaper with a powerful media franchise, saw its stock get hammered. Buffett, having done his scuttlebutt and recognizing the incredible quality of the business and its unassailable moat in the DC market, started buying shares aggressively. He bought so much, in fact, that at one point the investment constituted a huge portion of Berkshire Hathaway's portfolio. It was an incredibly concentrated bet. His partners and friends were nervous, the newspaper industry was facing headwinds, and the stock market was in turmoil, but Buffett had done the work. He had supreme confidence in the long-term economics of the business. He didn't just buy a small token position, he backed up the truck. And he held on. That investment went on to become one of his most successful ever, compounding at a spectacular rate for decades and delivering a return of more than 100-fold. This story teaches us a critical lesson about portfolio architecture. When you find a truly exceptional opportunity in a small pond where you have an edge, diversification can be the enemy of outstanding returns. The goal is not to have 100 tiny bets, but to have the conviction to make a few meaningful bets on your absolute best ideas. This level of conviction runs directly contrary to our innate psychological wiring, specifically the principles of prospect theory, for which Daniel Kahneman won a Nobel Prize. At its core, prospect theory demonstrates that humans feel the pain of a loss approximately twice as strongly as they feel the pleasure of an equivalent gain. Losing $1,000 hurts twice as much as finding $1,000 feels good. This loss aversion has devastating consequences for portfolio management. It causes investors to cut their winners too early. As soon as a stock is up 30 or 40%, the fear of losing that gain becomes overwhelming, so they sell to lock it in, prematurely cutting off a potential 10x winner. Conversely, loss aversion causes us to hold our losers for far too long. When a stock is down 50%, selling it would mean realizing the loss, which is psychologically painful. So we hold on, hoping it will get back to even, often riding it all the way down to zero. A portfolio structured for asymmetric returns requires you to consciously override this flawed programming. It means being psychologically prepared for several of your small-cap exploratory positions to lose money. You must be able to cut them without emotion once your thesis is proven wrong. But more importantly, it means you must have the stomach to let your winners run. When a stock doubles, you don't sell. You reevaluate your thesis. Is the business still great? Is the runway for growth still long? If the answer is yes, you must have the discipline to do nothing, to let that winner continue to compound, even if it grows to become a large and uncomfortable position in your portfolio. This is psychologically unnatural, but it is the only way to capture the rare 10x and 100x returns that generate life-changing wealth. So how do we build a practical portfolio structure that allows for this, while still managing risk? The most robust mental model for this is the barbell strategy, an idea popularized by the author and risk analyst Nassim Nicholas Taleb. Imagine a barbell, with most of the weight on one side and a small amount of weight on the other, with nothing in the middle. This is how you should structure your investment portfolio. On one side of the barbell, you place the vast majority of your capital, say 80 to 90%, in extremely safe, stable assets. This could be a low-cost S&P 500 index fund, government bonds, or even shares of Berkshire Hathaway itself. The goal of this side of the portfolio is not to generate spectacular returns, but to preserve your capital and protect you from ruin. This is your foundation of safety. On the other side of the barbell, you place the remaining 10 to 20% of your capital. This is your high-risk, high-reward allocation. This is where you put your basket of carefully selected small-cap stocks that you identified using the hunter's checklist. You might divide this 10% into 10 1% positions. This structure is brilliant because it caps your downside. The absolute most you can lose is that 10 or 20% of your portfolio, but your upside is unlimited. If one of those 1% bets becomes a 50x winner, it alone can have a massive impact on your total net worth. The barbell strategy allows you to be both extremely safe and extremely aggressive at the same time. It protects you from the emotional errors of loss aversion while giving you exposure to the explosive, asymmetric returns that are only found in the world of small-cap and venture capital-style investing. The antithesis of this smart, structured approach is where the 99% of investors live, the middle-risk portfolio. They avoid the safety of index funds because they think it's boring. And they avoid the high-risk, high-reward world of true small-cap hunting because they think it's too dangerous. So they end up in the mushy middle. They buy 15 to 20 well-known medium to large-cap stocks that are all highly correlated with each other and the general market. They own Coca-Cola and Nike and Home Depot. They feel like they are sophisticated stock pickers, but they have constructed a portfolio that is the worst of all worlds. They have taken on individual company risk. If one of their stocks blows up, it will hurt. Without the true diversification of an index fund, and without the explosive upside potential of a well-researched small cap, their portfolio is too timid to generate life-changing wealth but too concentrated to be truly safe. They have eliminated both safety and asymmetry, leaving them with a high-maintenance portfolio destined for mediocrity. The barbell strategy forces you out of this dangerous middle ground and into a structure that is both more robust and more potent. The direct financial connection that makes the barbell strategy so powerful is its embrace of the mathematics of power laws. In many systems, including venture capital and growth stock investing, returns are not distributed evenly in a bell curve. Instead, they follow a power law distribution, where a tiny number of events account for the majority of the results. This is often called the 80/20 rule, but in investing, it's often more extreme, like 95/5. In a well-selected portfolio of 10 small-cap growth stocks, it is a statistical likelihood that 5 or 6 of them will go nowhere or fail completely. 2 or 3 might deliver modest, market-like returns, but 1 or perhaps 2 will be a monster winner, a 20x, 50x, or even 100x home run. That single winner will generate more profit than all the other positions combined, paying for all the losers and producing the vast majority of the entire portfolio's growth. The venture capital mindset is built entirely around this mathematical reality. They know they are hunting for the one outlier. When you structure your portfolio as a barbell, you are explicitly adopting this venture capital mindset. You are treating the 10 to 20% portion of your portfolio as your own internal venture fund. You accept the small losses as the cost of doing business, the price of admission to find the one company that can truly transform your financial future. This is a concept completely alien to the investor who only owns large, slow-moving megacaps, where the range of outcomes is narrow and the possibility of a 20x return is zero. By understanding and harnessing the power law of returns through a disciplined barbell architecture, you create a direct path to the kind of exponential portfolio growth that can fund your financial freedom and build a legacy of true wealth. You have made it through. By investing your time and focus, you have done something most people never will. You have moved beyond the surface-level chatter of the market and grasped a fundamental mathematical law that governs the creation of wealth. You now possess the mathematical and psychological lens to see the market not as a popularity contest, but as a vast ocean of opportunity, where the biggest treasures are often hidden in the quietest depths. You understand why the giants of today cannot promise you the returns of tomorrow, and you now know where to begin your hunt for the giants of the future. But understanding where to look is only the first dimension of the map. The law of large numbers tells you which ponds to fish in. It doesn't tell you what kind of bait to use. The second, and perhaps more critical, dimension is understanding the specific economic, moat, or competitive advantage that separates a future 10x winner from a small company that will simply stay small forever. Why could See's Candies raise its prices every year for 50 years while its competitors could not? What allows one software company to build an unbreachable fortress around its customers while another is constantly fighting off rivals? The principles of identifying those moats are a completely different set of mental models. The video on your screen right now is the next piece of that map. It is the link that connects the where, the small ponds we've uncovered today, with the what, the specific business characteristics that create unstoppable compounding machines. Average investors stop here. They learn one trick and think they've finished the puzzle. But you've demonstrated the patience and the intellectual curiosity to get this far. The question is, are you building a hobby or are you building an arsenal? The choice to complete your understanding, to forge that next vital link in the chain of your financial education, is right in front of you. Continue your ascent.